So last class we were talking about relative value analysis. Was Arian one calling you?
Oh, yes, sir.
Okay, he's in, so I don't know what happened. So which ones do you use? The capital IQ model that I have, it does not do price to book very well. So if your industry needs price to book, that model is really not set up to price to book because there's no balance sheet in that model. It's only income statement stuff. So you're probably going to have to use, they use EV to EBITDA, but you can use EV to sales because sales is in there. So you have to pick one. So if you want to use price to book, it's going to be much more, except for the industrials. It's much more for the industries are going to do in the spring. And so we'll have to see how we figure that out. Maybe you can find some way to bring a balance sheet into it. But EV, the revenues, and EV, the EBITDA are two ratios that are built into that model that you can definitely use. I'll show you today when we look at the model how to do that. So we use it for screening in our cases. So we use our financial analysis model to rank companies, and we compare that ranking to their valuation ranking, and we're looking for differences. So is our number one company also the most expensive? Is our worst company also the cheapest? Are there some differences? It doesn't mean we're gonna go out and buy those companies. It'd be nice if we could backtest this model and see, are the ones that are ranked high but have the biggest valuation difference, do they actually outperform the market going forward? That would be a good thing to do. One thing I will say about backtesting. So backtesting is to see if your model actually outperforms. So does your buy list beat the market? That's what we're interested in. Backtesting is really, really hard to do. Mainly because companies disappear. They get merged, they go out of business. And so something called survivorship bias. So you have the issue of you test your model back in the 90s and the 2000s, say, wow, it worked really well. Well, maybe it works really well because some of the companies you bought actually went insolvent and now they don't exist anymore. So your model's not picking them up. You know, if you'd had your model in 1990, you would have picked up blockbusters. But since it doesn't exist now, it's not on your model, so you don't have that. So that's survivorship bias. And it's hard to handle companies that merge. You know, if Whole Foods would have been in your model, that probably would have helped you when they got bought out. So it's really hard to backtest. But how can you backtest? An easy way to backtest is what? Start now. Start collecting performance. So we're going to do that. Once you start giving me stocks, we're going to start doing that. We could do this with our buy lists. We could set up our buy lists and see how it performs versus the rest of the stocks in the industry. So I encourage students. I've had some students to say they want to start a hedge fund, and I'm like, start now. A good friend of mine started a hedge fund. Once you have 3 years of data, you can actually you can have your hedge fund working for almost very low cost. It's actually pretty inexpensive. So what he did is he ran his hedge fund for 3 years just with his own money and family money. Once you have 3 years, it has to be audited. So you got to spend a few $1,000s on an auditor. You have to have a custody bank. So you got to spend money on custody bank. But once you have 3 years of data, you're set. Because now the consulting firms have your data and they'll start recommending you. You don't have to hire any staff. You don't need any marketing. He had a department. He had 3 people in his company. He had an IT person, another portfolio manager, and himself. And they were making, I mean, I think I've told them, I mean, his worst year, he'd make $800,000. If he had a really bad year, he'd make $800,000. In good years, he was making millions. And I visited his company. I think I told somebody, I visited his company. His office in New York City was bigger than this classroom. 3 people. He's spending $7,000 a month. It's why don't y'all just work from home? Why do you need? We could have played tennis in his office. I don't know why, but they're making so much money. It's like, why not spend an extra 7,000 a month? It echoed in there because there's not much there, but he had to have that 3 years. So you can't just start a hedge fund. You have to have the 3 years. It's going to cost you some money.
Well, where did he get, like, how much family money did he have?
He worked at USA. He was the head of the international stocks, and they just saved. And his wife, made a lot of money. She was the primary, she worked for S&P for a few years, and then she was the #1 fundraiser for Columbia University. So she made quite a bit of money. They were doing well. There's a question they were doing well. But essentially, if you want to do a hedge fund, you're not going to buy a $80,000 car. You're not going to buy a $800,000 house. You're going to live in a cheap apartment and drive a 10-year-old car, and you're going to sock away every penny you have, because you're going to need several $100,000 to start your hedge fund, because you have to have data to put into the model. No one's going to invest with you when you have 0 months of actual performance. You need actual, but he got 3 years of data. He was doing long, short. I used to have him talk to this class, but he's retired since, so he's kind of out of it. He could still talk to you. He's a smart guy. But it was long, short, doing emerging markets kind of stuff. He was fluent in several languages. So yeah, you can start your own hedge fund, but he didn't start out of college with a hedge fund. He was doing portfolio management for several years. And guess what he said his #1 network was? Any guesses on that?
UTSA.
Well, his college peers. People sitting in class, he said, was his #1 network. Those were not his professors, even though you should get to know your professors. You should be hounding Dr. Pat Packham and Beepam and Wald, and man, I don't know y'all's last and first names. I know one or the other. You also be, I got to know Dr. Miser really well, which is the only reason I'm here. He called me up one day, but get to know at least one of your professors really, really, really well, but get to know your fellow students. So you can do it, but back testing, he couldn't do the back testing. He didn't have the data. So he essentially had to start his firm and create the back testing himself by getting 3 years. Once you get 3 years of data, he was long-term emerging market, which is somewhat of a unique strategy. So the consulting firms just started recommending them, and he just started getting calls from people wanting to invest with him. It's a pretty good life, right? Wouldn't you like to make your worst year ever be $800,000? That's not a horrible life, I don't think. So anyway, all right. So let's look at this relative value model. It does have a YouTube video in it. You have to be on Bloomberg to get it. The Bloomberg model obviously won't work on this, but the key here is you put your ticker there, and there's even instructions here. When you put this ticker, you can change the start date. If the start date is too early, you'll get a bunch of NAs. So modify the start date so you get the data that you want. You're probably going to, you notice EBITDA, the EV to EBITDA, there's some problem with the data that it's not updating. It does update after a few years, but initially, well, even then, it's just not changing. I don't know why it's not changing except for quarterly. So there's some issue with that number, but the PE ratio, these other 3 ratios work. So you get your data in, pick your date that gives you the data you need. So the day I work with Nicholas, his firm only has like 3 years of data. We were able to fix his beta pretty well. His company looks horrible, but he had 2 competitors. They had good betas. So I can work with you. We did what, 2-year rolling instead of 5-year rolling, because he only had but he still got a pretty decent chart. It took us what, 3 minutes to get it to work or something. So so if you're having trouble, you don't have enough data, we can get it to work. Same thing on this model. If you don't have enough data, modify the models. I think actually on this we set this up for Nicholas, and it actually worked pretty well, right? Didn't it, for this? Or was that might have been area, and I can't remember who it did. You did. So yours worked, actually got pretty decent looking numbers. Yeah. The other thing you have to do is you have to pick your industry over here. And what I did here is I have a combination of sectors and industries. And it's not alphabetical. I should have done it, but kind of look through and see what makes most sense for you to compare against. So I do have tech, hardware and equipment, telecom, transportation, utilities, materials, the industry, materials, the sector. So I have a lot of choices in here. So pick the one that makes the most sense. And that way you'll get the PE ratio for your industry, for your company and for your industry. You'll then copy and paste that here. You don't need to do anything else on this page other than copy and paste. All right. It has everything you need, including your current price is out here somewhere. I don't know where I put it, but the price is out here somewhere. Yeah, I did it, yeah, somewhere in this spreadsheet. One thing you have to do, watch out on the output is right here. If you want to do graphs, if you do an in down, it might go way beyond the data because the way this formula works, it says if there's no data there, just give me empty cell, but it will keep going down if there's empty cells. So what I would do is try to find the last date. You should have like 1028 if you did it through the day. And go one cell below that and end down and end right and just get rid of all that extra ones. So that if you're doing graphs, you can use the end down key and highlight much more easily. But the video shows you how to do that. So what I have now is Walmart's. This is the PE ratio. Let me look at EV to sales. I have Walmart's EV to sales relative to its industry and relative to the S&P 500. So what this is saying is Walmart over time has traded really cheap to its industry. Really cheap to retail sales. Why? Retail companies. Why? Because it's a discount store, really thin margins. So it trades really, really cheap to a Target or to other stores. To the S&P, it trades cheaply, but not as cheaply as to its industry. There's the median. Here's where they are today. So right now they're trading, this is EV to sales. They're going to trade really cheap on EV to sales. When your margins are thin, you're going to look really, really inexpensive. So currently, they're trading at 8% of what the industry trades at. Historically, they've traded at 14%. So right now, they're 39% cheap versus their history. All right. You don't need to use this chart, but if you want to, you can actually graph your company versus the industry. So if I wanted to graph Walmart versus the industry, you could actually create a graph to show that they're trading pretty cheap to their industry versus their history. And you can look at them versus the S&P. You're actually trading in line with the S&P. I tend to do it versus their industry. But that's this page, this output page. You only need this if you can do graphs. If you might want to do a graph, you want to show how this firm's trading today versus its history. It's really, really good thing to do. Here they are on a PE basis versus their industry. You can see they're a little cheap on a PE basis. They've been expensive at times. Right now, they're fairly cheap. They've been really cheap. So you can compare them over time if you want to do graphs. So this output page, just put it in your notes. The purpose of the output page, if you want to do graphs where you want to show these relative values over time, you can do really quick graphs that way. I don't know why I'm getting an NA requesting here. Somehow when I copied and pasted it, wasn't finished running the Bloomberg stuff. All right, questions up to there. I'll show you the main output. So pull it from Bloomberg. Only have to change two things on well, three things. You got to change the ticker first. Change the ticker. Change the date. Change the industry, and then copy and paste it to the next page. All right. If you can't get here to use Bloomberg, I'll do this file for you and email it to you so I can do it. It only takes me a couple minutes to do it. So if you need it, let me know. I can get you the data. But hopefully you can get in there and use Bloomberg. Do most of y'all have access to Bloomberg? I know it closes at 5 o'clock, but I usually have it open until 7 on Tuesdays, or until 6. Tomorrow I'll be here till 7:30. So if you need, and I'm talking to another alum tomorrow at 6 o'clock. He's one of our healthcare experts. So I'm hoping he'll talk to us next semester. So am I going to freak y'all out in 5 years when I ask you if I can Zoom with you? So yeah, I don't know how many professors do that. I feel like I'm kind of bizarre. Maybe some others do, but I'm learning a lot. I learned a lot today from Johan. I told him I was really proud of him because he said, yeah, those Ivy League school students, they're not all that good. They got Ivy League behind their name, but they don't know much. And so, yeah, he's talking about how he wasn't scared of them at all. Some of y'all discovered that too, right? They're not that intimidating at all. But Is it like they have better professors? No way. We got Catapacum, we got Wald, we got Baynut, we got great professors. Are they smarter than you? No way. I know they're not smarter than you because I've interviewed them. Yeah, so Johan's like, let me talk to your class and tell them just go get the job because you're good as anybody else. So we need to hear that, right? Y'all need to be bold. So I'll talk to Devin next, see how he's doing on the healthcare side. All right, so that's how this file works. Let's look at the analysis and ranges. So what I've done here is I allow you to put a range. I like 10%. What 10% says is give me the 10th percentile and the 90th percentile. So we're looking at that middle 80%. I did try this with the standard deviations. Give me a 1 sigma event. So a 1 sigma event, what percentage of the time is that? Y'all remember that from stats? About 2/3 of the time, right? So here I'm using about 80% of the time between your 10th and 90th percentile, whether they trade. You can make it a different amount. You can make it 20% or 5% if you want to, but 10 is kind of that middle. If you do 5%, you're capturing the middle 5%. I mean, middle 90%. Then you got to ask, what are you going to compare it to? For the capital IQ model, you're probably going to do EV to sales or EV to EBITDA. Those two are set up. You can do price to book, but that's not in that model. Remember, in that capital IQ model, you're going to need to run some ranges on your relative value, and you're going to get it from this model. And then what are you going to compare it to? So here I'm comparing it to their industry. You can compare it to the S&P. I'm comparing it to their industry. And so historically, Walmart has traded at 86% cheap to their industry. All right. So what this formula is, it's Walmart EV to sales divided by the industry EV to sales. This is not Walmart's EV to sales. It's their EV to sales divided by the industries. So if we look at it, their EV to sell is 0.65. The industry is 2.63. So you can see how cheap they are to the industry. I'm sorry, where's EV to sales? Right there, EV to sales, 0.65 was 2.63. All right, so I'm just taking 0.65 and dividing by the 2.63. And when I started this, they were trading at 0.25. If I look at the median for the whole period, it would be 0.14. And again, why are they so cheap? Anybody remember what I just said on that? Why are they so cheap on EV to sales? Because they have what? Very thin margins. That means when you're looking at them on a revenue basis, very little of their revenue gets down to the bottom line, so they're going to have to be really cheap on an EV to sales basis. They'll probably look more expensive there. So they're only 15% cheap there. That makes some sense, right? And yeah, they've got a lot of cells, but not much of it gets to the bottom line. So when you're buying their cells, you only have to pay 65 cents, not $2 for it. All right, so that's what that is. The current is only 8%. They're trading 92% cheaper than the firms in their industry. And so we can look at that at the very, very bottom here. They're trading at 127 versus, I got the right columns, 127 versus 1529. They're only 8% of the industry. The 10th percentile, 10% of the time they trade at 8. So where are they trading today? They're absolute low level. Their 90th percentile, they've been as expensive as 19. So today they're trading 39% cheap. They're at 8. They're normally at 14. They're trading 39% cheap. Now, why is that? Could be that they're cheap. Could be that the industry is expensive. It could be there's something wrong with them. I think Walmart's doing a pretty good job, aren't they? They're doing some pretty exciting stuff. So, but then to Luke's point, on EV to EBITDA, they don't look so cheap. They're only 6% cheap on EV to EBITDA. Why is that? Are margins changing? Are margins getting wider, thinner? You know, there's a lot of things. Do you need to figure that out? What do most people in practice do? They pick the relative that makes their story the easiest to tell. Not to be cynical. Rajan didn't hear me say that, but yeah, most analysts, they decide whether they want to buy the stock or not, and then they find the relative that best makes their story. So what makes most sense for Walmart? EV of the revenue, right? That's just what you use for this industry. It won't let me switch it back. So that makes the most sense, but you can get radically different answers between these different firms, depending on which one you do. I understand this part of it. That's all done for you. You see your selections you've got to make here. Your model will say Walmart here, even though you changed it. They won't change it until you hit the list for the first time, and then it will change it to yours. So don't freak out about that. Same thing here. You know, look through and see what you want to do. We can look at a PE ratio. PE ratio, they're pretty cheap on a PE ratio, but not as cheap. You know, they're the most expensive on the EV to EBITDA. So if you don't like Walmart, use EV to EBITDA. If you really love them, use EV to sales. It's essentially what we do. All right, so what does that mean? Their current price for this is old stuff. I did this back in August, but their current price is 101. If they're trading at the median, their current price would be 141. If they're trading at the 10th percentile, their current price would be 103.01. The 90th percent would be 236.02. So what do we do with that information? Well, remember the DCF valuation, the football chart? You just make that, you put those ranges in your football chart. What you think makes reasonable sense for your firm. All right, so that gives you, this one was what? Gordon, growth, H model, EV to sales. So we're starting to build, we're starting to build the football chart. I don't know what we call this, but come up with a term. I think I gave you one last class for the Cap IQ model. Put something in there that sounds pretty interesting. Remember Johan, I wish I could show you what Johan, I should have filmed it. I think he was showing me proprietary stuff, so it's probably good I didn't. But he had, I mean, his football chart could have been like 19 things. And you just click on which ones you want, and the computer built them all for you. So it's pretty cool. When you love to have his model. He could do public companies. He pulled his public company information from Cap IQ, but then he pulled his private firm information from PitchBook. And AI and his model did all the work, and you just had to change the assumptions very similar. I mean, while he was doing his model, I was like, man, I feel like I'm watching my class, because it was, especially when we get into a Cap IQ model, I mean, it was like exactly what we're doing. So Cap IQ model, you won't call it that, but whatever that is. Find something that sounds fancy. I don't know what investment bankers call their models, so I don't know what that is. And here you might do the 52-week range, something like that. So y'all see how easy the football chart is to build. It's all set up for you. Yeah. Can you imagine a football chart with like 17 things in it? You're going to be all over the place. It's just going to be pretty wild. I'll show you next class. I think I'm going to finalize what I really think on Walmart, because my assumptions, I didn't think much about them, but I'll show you what I really think. Is anyone in here doing Walmart? Where's our computers? Staples. Anybody doing Walmart? Did they come up on y'all's list?
Yeah.
So we'll see. Well, maybe I should let Adrian present it. I don't know. Who's doing Walmart? Do you know?
No, it's Pablo.
Pablo, you doing Walmart? Well, maybe we should compare notes and see if we agree on Walmart. But I think Walmart's one of the easier companies to value, because it's not like they're doing anything really radical. They are pretty heavy overseas. They're having some success in India finally. That's pretty important, right? You've got 1 billion people and you're finally having success. They certainly are taking over Latin America, other than PriceSmart. Someone's doing price marketing here though, right? Who was doing price? That's Adrian. Yes, so they're pretty heavy Latin America. Um, so it's hard to get excited about consumer staples, but there are consumer staple firms doing really exciting things. And so, but I don't expect my range on Walmart to be as wide as it would be if I'm doing Palantir or doing, well, gambling.com, that company. I don't know what Nicholas is going to get $2 at $87 or something. It's going to be pretty wide range. So,
Are more complicated companies be like valued higher or lower? Or is it just a wider range?
well, the one thing we're not doing here is a contingent kind of claims analysis. So a lot of younger companies, they have optionality that you don't see in a Walmart. So they got this particular software package. Well, if it takes off, man, it can be $1 billion, $2 billion. It doesn't take off, it costs them $100 million. So it looks like an option. Those firms will always look expensive because that option's not in their cash flows. And so when you do content, and the motor end, he has a contingent claims model you can actually use if you want to and plug the numbers in, but it's really hard to come up with assumptions on those kind of things. So newer companies tend to have that kind of optionality where they got 6 or 7 things they're thinking about doing. And if they do them and they work, it can be world changing. If it doesn't work, it doesn't cost them that much. It's hard to me to think of something that Walmart's doing that's going to be like, wow, if they do this, they're going to change everything. So yeah, smaller companies look more like options than stocks anyway, because there's probably a 60-70% chance you're gonna fail. But there's a 1% chance they're the next Microsoft. And so, how do you value something like that? It's more of an option. So those kind of firms are gonna look expensive because you're valuing what they're currently doing, but there's a chance things take off. So it's tough. So like gambling.com, we're talking about that is that a platform business? Are they can get the advantage that I was telling Nicholas, I think just the fact that they're gambling.com gives them a huge advantage. If you're a gambler, where are you going to go first? You're going to type gambling, right? So that by itself gives you an advantage. But what advantage do they have? Do y'all really care? Does it make a difference which gambling site you go to? Does it give you an advantage if you have a lot more gamblers on your site than other people do, like Meta or Facebook or something, so you kind of think through that. So I'm curious to see what Nicholas comes up with because I think that's going to be a really, really tough firm to value. But it's upside versus downside is what I'm looking at. He's kind of the price. A lot of times, like on a firm like Palantir, you're asking, are they pricing to perfection? So this firm has to get everything exactly right for this valuation to make sense. Are they pricing to pretty good? And if something really takes off, you still have a massive upside. You may have a lot of downside. Your downside might be 60%, but your upside might be 40,000%. And in that case, maybe you take the risk. But in that case, we're probably not going to put 2% in Nicholas's stock. We might put 0.5% and play it as a gambling, we'll gamble on gambling.com and see, because it might be that kind of stock. Does it bother you that your football chart is massive? I remember when we were in the sector wars, we were doing football charts like that, and one portfolio manager, I forget where he was from, and he said that's just wrong. You can't have ranges that wide. I actually personally think that's the right range. I actually think we don't know the future that well. Always did I tell y'all the story about the 2000 when I was teaching this class in 2000? I tell y'all that we did JDS, we valued it in class, and we came up at $4 a share. I didn't tell y'all that story. So we valued JDS at $4 a share. It was currently trading for $100. And one of the students goes, "Oh man, this stuff's just so academic. It's just so worthless." Guess what JDS was trading for a year later? Any guesses? $4. What if he had said, "Hey, this academic stuff makes some sense. Let me go short JDS." He'd be really, really happy. But no, he said, "No, $4. How can we get $4 for a stock that's trading for $100? There's no way that's right." Now, I'm not saying that we were that good in valuation. That's pure luck. But still, we valued something that was $100. We valued it at $4, and a year later, it was trading for $4. We had a team in the CFA Research Challenge. Guess what their stock was? GameStop. Have y'all heard of GameStop? How close do you think their valuation was? You know, they could have flipped coins. They would have been closer if they flipped coins. There's no way they predicted that stock was going to be up 400 and something percent. So, I mean, it's really, really hard to value companies. It's really tough to do. That's why you do a bunch of them and you get a range and you're looking for those firms that have more upside than downside. It really is a distribution. You're trying to be more right than wrong and then apply that to as many different examples as you can so that you hope that statistics will drive you up there. So your ranges, I actually think your ranges being wide is honesty. I think it's what we really, really know. And again, I got to bring in the CFA example. Doing Merck, it was a really, really wide range. But there are people out in the business that really bothers them. If you interview for them and you show them a wide range, it might lose you the job. And they say, how can you say it's worth between 25 and 70 bucks? That's just too wide of a range. But for something like gambling.com, I think that could be realistic. I actually think something like gambling.com it's either going to go out of business, get bought out, or it's going to be the next, mega star. What probabilities I give that? Go out of business, probably 60%, get bought out by somebody else, 30%, and maybe 5% chance they're going to be a next mega company. Who knows? But if there's a 5% chance they're going to be a $200 billion company, is it worth betting on it? If it's a $50 million company, yeah, it may be worth it. So it's kind of hard. The statistics is pretty tough. All right, y'all see where we're going. Now I'll next class try to go through a full blown example of Walmart, unless someone's doing Walmart and they want to do it with me. All right, everybody's clear where we're going? So you got the valuation model that gives you two valuations. You got the relative value that gives you a valuation. And then the last one is the capital IQ model. I've got to work on this model and I'm going to work on it hopefully tomorrow. What I did here is I copied and pasted all the green stuff are capital IQ formulas. And I know y'all are struggling. I mean, Paul, I don't know how many emails I got from y'all on that. Paul was trying his best to get capital IQ from home, and it's just
They can be done.
yeah, I read two of your emails and well, if Laura can't get it done, it may be impossible because she works really hard, but she seemed to think that if I send an email that somehow magically fixes it.
I think that would
Would it? Okay, well, you draft an email and send it to me and I will send it and tell me when to send it to you and I'll do that. But if you can't get capital IQ from home, what I'm going to do, and I had done it before, but I lost the file, is I'm going to take all the capital IQ formulas and put them off on the side. And then here, just reference capital IQ so that what you can do, once you get the capital IQ data from the FSC, you can just come over here and copy and paste all of that as values, and then you have it. But so I did that with this spreadsheet, but it's the problem, the way they did it, which is, y'all saw how I set up my formula, my files. So you have all the Bloomberg stuff on one page, all the cap IQ on one page, with one exception on the DCF model, the rolling beta, that's a separate page. So you do need to value those, but I try to put all those references to cap IQ and Bloomberg in one place. So you can get your data, copy and paste it as values, and then you can use it from home. So I'm going to try to get this file to do that. What you'll notice with this file is there's a lot of assumptions that come in. And what I did is I numbered ones I believe you're going to want to change. So one is the risk-free rate. So you can plug in your own risk-free rates. So you're not using a different risk-free rate here than you use in your DCF model. You want to keep that consistent. I put here the market risk premium. You can plug in your market risk premium. So you're using that. Be real careful. This is not the expected return on stocks. This is the actual market risk premium. It doesn't look correct, does it? 12%. Would Demodrin ever use 12% for market risk premium? He's using what, 4 to 6 to 7%. Why is it so high? What do you notice that they're doing here? What approach are they using? We're using the implied approach. What approach are they using? It's historical. And how far back are they going?
10 years.
10 years. And how have stocks done the last 10 years? Pretty well. Do you think people investing in the stock market are demanding a 12% return over 10-year treasury right now. I sure am not. So put in your own market risk premium, okay? So those two numbers, just pull them from your discounted cash flow model and plug them in. So you're using the same numbers. You don't want a valuation in this model that's radically different just because you use a different 10-year and use a different market risk premium. All right, so use those numbers there. What else do you think you might change? What about your beta? All right, so your beta goes there. How many betas will you use? Well, how many betas did you use in your DCF model? So you have a high case, a low case, and a medium case. Use those three betas here. So you'll end up with 9 valuations here, right? So there's the third thing you change. The fourth thing you change is right here in Q99, and that's your price relative. You're using EV to EBITDA, but you can use EV to EBITDA or EV to sales. What are you going to plug in here? That same range you use for your relative value. What's your low end? What's your high end? What's your medium? What's a median? Put that in there so you can get 3 betas, 3 relatives. It's going to give you 9 stock prices. It's going to give you a pretty good range on your stock valuation. All right. So those are the 4 places. You might write these down so you know them. So so H14, H15, the risk-free rate, the market risk premium, H36, and Q99. Those are the 4 things you want to change in here. 2 of them you want to do scenarios on. The beta and the relative value you want to do scenarios on.
The labels, capital IQ labels or your labels?
These are the
12.2%. It says 10 years RM. RM minus RM.
up here.
Yeah.
That's Capital IQ's model.
It says RN. Is it the risk premium or the?
It's the market. Oh, that is the market return. Sorry. Good point. I'm glad you pointed that out. That is the market return. Where is the market risk? I'm glad you pointed it out. I was misreading. So that's 10 years. So what should you put in here? So good point. You should put in your expected return on stocks here. Right? Sorry about that. That's still a really high market risk premium, it's 8%. So put the market risk premium in here. Put expected return on stocks. Boy, I'm glad you caught that. So put your risk-free rate in, put your expected return on stocks there, put your beta risk there in H36, your range on beta, and in Q99, you'll use your relatives. Make sure on Q99, this is based on EV to EBITDA. If you use EV to EBITDA, then the model's set up for you. If you use EV to sales, there's one other place you have to change the model. And that's right here at H99. If you're using EV to EBITDA, make sure you're referencing EBITDA. If you're using EV to sales, make sure you're referencing sales. That's the only other place you have to adjust the model. All right. So let's walk through the model. Any questions? Good catch, Rajan. Any questions on it? Did I confuse y'all on this?
So the capital IQ model. And then, wait, did we go over the investment banking one yet?
This is an investment banking. This is a typical investment banking model.
Okay.
When I was talking to Johan today, it looked exactly like this. It was amazingly how consistent it looked like this model. And they're selling this, for $10,000 a year, but pulling data using a lot of AI, doing a lot of text writing is AI. They're trying to use more and more AI to have it automatically write a lot of the text so that you don't have to have a human go in. All right, let's look at this model. So obviously it starts off with your discount rate. I don't change the tax rate. I'm assuming Capital IQ does a good job of bringing in tax rates. You need that to get the weighted average cost of capital for the firm. You're going to change the risk-free rate. Here's a size premium. If you want a size premium, you can put that in. So if you use a size premium on your DCF, put that in there.
What is that?
Well, for small companies, you might add an extra 1% risk premium. For international companies, where can you get this? If you're gonna use this, the Motorin. We'll do that, the Motorin. I mean, I saw Johan, guess what Johan Van firms use? They use the Motorin's charts. They just take his charts and that's where their risk premiums are coming from. I think they're even using the market risk premium coming from the Motorin. So if you want to do a size premium, you can use that. Some of your firms will have a size. Some of your firms are pretty small firms. I'm not sure what's going on there. I'll have to check that. But I would trust their cost of debt. I don't know what's showing 0 there, so there may be an error in the file where I forgot to fix one cell, but I'll see. I'm going to work on this tomorrow and get it so it works. And then you have your beta in there. You can key over that. You don't have to use their beta. They do have a beta approach that they use. You can look at that if you want to, but make it consistent. You don't want your model valuations to come out different just because CapIQ is using different kind of key inputs that you already have. You don't want to be getting different valuations because you're playing around with different betas from different sources. Yeah, there's definitely something going on with the debt here, so I'll have to figure out what's going on there. That's probably a CapIQ model. I'll probably just a CapIQ issue. I probably just got the copy and paste the cell. When you do all of that, what they're going to do is take those discount rates and they're going to value the firm, not the stock, value the firm. They're going to take the present value of free cash flows over the next 5 years. They're going to get the terminal value. The terminal value is your target EV to EBITDA times your EBITDA in 5 years. That's your final terminal value. So that's set up there. That gives you the enterprise value. So the present value of those things gives you the value of the firm. They subtract out the debt. They subtract out the preferred stock. They subtract out minority interest. They add back cash. They get equity valuation. All right. Is this similar to the model you use, Dr. Catapacum? I mean, it's very similar, right? Other than I got a problem with it.
Minority interest.
So they think it's worth $700 billion. They have the shares outstanding, so if they think Walmart's worth 88 bucks, it's currently trading for 103, so they think it's 14% overvalued. All right. You can't just pull up this model, change your ticker, and say, here's my value of my firm. Right. That's why I gave you those cells you want to look at. Right. So just be careful on those cells. So what else is in here? So let me show you ignoring the forecast. So there's a big forecast in here, but ignoring the forecast, you'll see how it's working. You essentially can, and if you can essentially stay in these first 5 columns and see the results of everything, because the valuation is there down at the bottom. So the valuation is at around 110, 111, 112. There's your valuation. There is a bunch of junk over to the right. You don't need to worry about that. They get a low overkill on what risk-free rate you're going to use and some other things that on those kind of things, just plug in your number. You can ignore all of that. I copied and valued all of these. And I will, let me see why this is an issue. BP13. Yeah, I messed up something on. Yeah, I don't know what I did here. So somewhere in here, it might have been, you might check when you're doing Capital IQ, it might have been Capital IQ that bring that data in by the time I pasted everything. So one cell that could be a good check is the cost of debt. It says if error, give me a 0, but I know Walmart's cost of debt is not 0. So I need to go back. I'm sure there's something with Cap IQ going on. So I'll fix that. But you can reference back, but you see all this data. It's not a very well built model because the pool data is just all over the place. It's in green, which is kind of nice, but it's all over the place. I prefer to have that all in one spot. One thing I think is really, really amazing for this model, they don't really use it much, but they do bring in competitors. And I think it's actually pretty cool how they're bringing in competitors. I don't know how they do this. But you would think with Walmart, who are the competitors? Well, they bring in Costco, so they've got a membership firm. They bring in Dollar General, which is a deep discount store. They bring in BJ Wholesale's another membership. Dollar Tree, bring in Kroger, a grocery store. They don't have Target in there, but you would think to be Target, but I'm not sure exactly how their algorithm knows which of these to bring in. I don't know if there's something in Cap IQ that kind of says these are the main companies. But it does do some interesting analysis. I will show you, I'll show you a chart in Bloomberg it's really, really pretty interesting, where you can bring in the competitors and compare EV to EBITDA and EV to sales and just look at them over, and Cap IQ has some of those models. So I might show you some of those models. I'm not suggesting you use those for valuation, but they look really good in a pitch book to show, hey, my company is trading, 20% cheap to its industry, but it's also, here's some key competitors. You can see where they're trading, see where I'm trading. That usually is a pretty strong argument for get your boss to buy a stock, because you can show that, wow, Target's trading at 15 and Walmart's trading at 12. That can be a strong argument. So I like this kind of approach. I have a table like this in your pitch book that you're comparing those key statistics. It can be margins, it can be turnover, it can be all of those kind of things where you're just comparing your firm. So having the key competitors, so you might even though we're not really using this data much, they're using this mainly to come up with their beta. You already have your beta, but you can use this to give you some ideas. I might not have thought of BJ Wholesales as a competitor to Walmart, and they bring that in suggestions, so I could look at that and see, oh, maybe that is something I want to bring in. All right. So you see how the valuation works. So the key here is this middle section down here, the discounted cash flow analysis. They call this discounted cash flow analysis. This is where the Modrin, he went out and asked his former students how many of them are using DCF, and they say, oh yeah, we're using DCF. And he discovered almost all of them were doing this. And he said, I don't think this is DCF analysis. It's true, we are discounting cash flows over the next 5 years, but in the 5th year, we're just taking net cash flow and multiply it by some relative. And how much of the valuation is in that? 91%, 98%, whatever. 91% of the valuation of Walmart is that relative in that terminal year. So is that discounted cash flow or is that relative value analysis? It's 90% relative value analysis. It's, the majority of it's relative value. So the Modrin said, I don't consider this to be discounted cash flow analysis. I consider this to be relative value analysis, because 91% of the value of Walmart is that relative EV multiplied by EBITDA in the 5th year and the present value of that. Some of your firms, this is going to be 100% of your valuation, because they may have negative cash flows for the first few years, and all of the profit is coming out in that last year. So is that relative value analysis or discounted cash flow analysis? I agree with the Modrin, that's more relative value analysis than discounted cash flow. The other problem with this that I was talking to Dr. Katapakam about is, how many years do you go out? How many years did they go out? 5 years. What is that last year supposed to be? It's your terminal year. What does terminal year mean? What do we mean by terminal value?
Growth rate becomes constant.
Yeah, it's your long-term constant growth rate. So not to pick on Nicholas, but is gambling.com going to be at their terminal value in 5 years? You sure hope not, right? If that's the case, you're probably not going to recommend them. So how far out do you need to go? You need to go out until you hit your long-term growth. So can you manipulate? I'm going to test this model. I haven't tried it yet, but I think it's certainly possible. You should be able to add more years to this model. I have to try it and see. I don't know how much it might mess it up. I'm going to fix it first before I try that. But I think it is possible to just insert some rows, some columns, and take that growth rate out. All right. So what they're suggesting is for Walmart, it's probably not a bad idea. Walmart's probably not that far from the terminal growth. But for other firms, they may be very far away. And there's other firms, Campbell Soup. When's Campbell Soup terminal value? They may be there, right? It might be this year. We've talked about before. What's Campbell Soup doing that's going to give them some hyper growth? And they own some. Maybe they need to get in emerging markets. Maybe they get sell in Africa and Asia. Who knows? But it doesn't sound to me like it's a high growth company. In that case, I would stick with this model. Stick with the 5 years. You may have the constant growth. Your 5 years growth is the same as your terminal growth. You can stick with it. But for other firms, if you do that, I think you have some of an issue of you're not really valuing the firm. But the other issue you have is your price relative also needs to be that terminal price relative as well. So you have to think somewhat about that. What would that terminal price relative be if this industry starts growing at normal rates? So that can be an issue as well. So just something to think about with this model. I think investment bankers have some huge oversimplifications that are really material to valuations, but their vision is valuation is such an art and not a science. Why do we need to be so precise? But I really think, think through it. I don't know, Catapacum, you have any comments on this? Dr. Catapacum?
That's the problem. The Damodaran, when he's valuing the startup companies, he takes out 12, 15, 20 years.
And then you're really uncertain about your assumptions at that point, that far.
The multiple, as you pointed out, should be the multiple that's expected to prevail, let's say 5 years out. Then rather than just stick a current multiple.
I gave you the one that prevails for PE ratio because it's whatever their ultimate beta. You can get that ultimate PE ratio from here, right? And you could convert that to get an EV to EBITDA, couldn't you? Y'all could figure that out. So their current EV to EBITDA might be assuming that their current growth rate is 30%. What would the EV to EBITDA be when their growth rate is 5%? So I think that's one reason I gave you this formula. I think you can come out, if their ultimate growth rate is going to be 5%, currently growing 30, their ultimate growth rate is 5%. What does that do to their PE ratio if you go from well, you can't put 30% in this model, but what would their PE ratio be if their long-term growth rate is 5%? And look at their current PE ratio. You can do a conversion between earnings and EBITDA and convert. There's ways you can convert this ratio. So think about that when you're looking at this particular part of it. You're not going to talk about that much in your presentation. Reed, you can clarify, confirm this. They don't ask that question in the CFA research challenge. I would be asking those kind of questions. What beta did you use? What your terminal growth rate? What did you use as your terminal relative? Isn't that high given, I would be asking all those questions. I don't know how y'all would have reacted to those questions. Those kind of questions I'm interested in. Why am I interested in those questions? Because they have a 30, 40, 50% impact on your valuation. They're massive. They're huge. So it bothers me that we're so, we go out 12 decimal places on the discount rate, and then we're like this on the most important inputs. So do put some more rigor and some thought into it because it's really material to your evaluation. All right, questions on that? That's a pretty big point. I'll help some of y'all one-on-one if you like on that. How do you get to that terminal? But it's important. Now, the other thing is they have growth rates on revenue. They have gross margins. They have net margins. You can key over any of these numbers, not the historical numbers, but you can key over any of these numbers All right, so you can create your own forecasts. So if you have an idea where revenue's going, you have an idea what their long-term gross margin, you can convert, you can key over any of these things. So if you think their revenue is going to grow 10%, you can type that in there. You can type 10, 9, 8, 7. So you have the right to key over any of these numbers. All right. So this is your forecast. This is line 67. This is the forecast. You've got revenue. Your cost of revenue is a percent. So you don't have to type in the numbers. You just type in the actual number. That one you probably can look at history and get a pretty good sense of that. EBITDA annual growth. There, it's going to be somewhat of a formula because you're going to use what the actual EBITDA margin is. So you'll see the blue numbers is really what you want to key in. All right, you'll see how you have some room there to work. So the huge advantage you have, and this is true for the CFA research teams, a huge advantage you have is you're rarely scrutinized on the most important assumptions. Does that mean you can be sloppy and flip it with them? Yeah, you can be. In past semesters, I was okay. Why is that not okay this semester? Because what am I going to do? I'm going to actually buy a stock. All right. So it actually makes a difference this semester. All right. So think about these things. They're extremely material and they tend to be pretty flippant and sloppy, not just in college classes. I think investment bankers can be pretty sloppy with this stuff as well. All right. So you have the model. I'm going to clean it up, fix it, and I'll get it out there hopefully this weekend. And then you'll have everything for valuation. So your goal is to get to your first pitch book. So you've got 3 or 4 stocks, do all of your valuations, do your football charts, and pick one of those stocks that you're going to deep dive and recommend as a buy. All right. You understand the process? All right. So next week, we'll start looking at your valuations and your pitch book.